Have you ever heard of families that get life insurance policies for the grandparents, the parents, kids, grandkids, and every generation after that? And the reason why is because they're following this secret strategy that have been used by families like the Rockefellers and other billionaire families for centuries. And if you would like your family to have massive amounts of wealth and be billionaires too, what you should do is buy lots and lots of life insurance. I would not do that. Now, there is some truth to those strategies when we hear of families getting life insurance policies, because life insurance has a huge benefit, especially when you look at the tax benefits and how those death benefit proceeds come into the family income tax-free, and we can access the cash value too. However, what we're going to talk about today is not the exact strategy that billionaire families do, but we are going to talk about something along those lines. We're going to look at this topic of generational wealth, and we're going to talk about a situation with Uncle Bob and his niece Jill. So Uncle Bob is interested in a whole life insurance policy for his niece. Her name's Jill, for the sake of this video, and she's 17 years old. So she's not at a point in her life where she understands money. She's not responsible yet because she's still growing up, but he wants to get a policy for her, and the policy is going to be for the family office. Now, Bob is interested in getting a policy for Jill for two reasons. One is the life insurance, because when Jill eventually dies, she's 17 years old now, so it's not going to be for a long time. But when she dies, the life insurance policy will be paid to the family office. What this means, I should say what it does not mean, is the life insurance policy will not be paid to Jill's family. It'll be paid to the family office, meaning the proceeds come in so they can be used by the entire family. Jill's immediate family, Uncle Bob's family, everyone that is part of this family office. So first, we have the life insurance. Second, we've got the cash value. Uncle Bob wants to be able to build up cash value for Jill. This way she can access it for opportunities. We'll talk about exactly how that works in a little bit. We'll look at actual numbers. So this idea of the family office, how does this work? Well, for Bob, how it's set up is he has multiple people, some of which are family members, some of which are not family members, but there are multiple people that get together to help make smart decisions about money, both from a number standpoint and also an emotional standpoint. Here's an example. Within the family office, it's trust owned, so the trust documents specify exactly when and how Jill can access cash value in her policy. Approval is needed by the four individuals below before she can get access to the money. Jill's dad needs to approve it, Uncle Bob needs to approve it, Liz, the family's tax advisor, needs to approve it, and also Stan, the family's business consultant. All four must meet together and discuss the reason why Jill wants to access this cash value before she can get it from the policy. What's the benefit to that? What does it prevent? It prevents family members from making irresponsible decisions, meaning Jill can't take her friends on a vacation to Italy because she says, hey, I've got this big bucket of cash value, let's go have some fun. No, the family's not going to allow that to happen. They want to make sure that she is using the money in a wise manner. So as an example, if Jill grows up and says, I'm 28 years old now. I've been working at a tech company. I know how this business works. I really want to start my own company, but I need capital to do so. I know that I've got cash value built up in this policy. Can I use it to start my own company? The group meets together. They say, from a number standpoint, this is high risk. Most startups fail, especially in the tech industry. But then the emotions come in. Uncle Bob might say, yeah, I understand the risk there, but he says to his brother, who is Jill's dad, bro, do you remember when we started our family business? Everyone said, don't do it, it's gonna fail, but we just did it anyway. And that's really how we were able to start this family office. Jill has that same drive in her. I think we should give her a shot. So they discuss it, and if all four say, okay, we're going to give her a shot, they'll approve the use of accessing that cash value, specifically through a policy loan. So the idea of a family office really has an office of family members and other individuals that are qualified to help make wise decisions about the money, about all family members' money. We're just looking at Jill in this specific case. Does that make sense? Okay, cool. So here's a question you might be wondering as you're looking at this, because a lot of people think that this is really, really cool. If a trust owns Jill's policy in this case, if you're considering doing this, do you have to have a trust before you get a policy in order to copy this exact strategy? And the answer is no, you do not have to do that. It could be a simple setup, which can be as simple as a parent getting a life insurance policy for their child. The parent owns it, pays it, has control of the cash value, and at some point in the future, they plan to transfer ownership of that policy to a trust or maybe directly to the child. Now, there are some things to be aware of in that case, a tax situation specifically when I'm transferring ownership. If there's a gain on the policy, there could be taxes. But my point is, we do not have to have a trust set up before starting a policy. Okay, on to the actual policy, because we talked about Uncle Bob's overall plan. Well, actually, let's recap it first. So a quick summary. Here's how it works. Bob gets a life insurance policy on Jill. Bob does not own the policy. Dad does not own Jill's policy. The trust owns the policy. Jill can access the cash value. However, the family office, which are these 4 individuals, have to approve it first. Now, on to the life insurance policy. They're getting a whole life insurance policy for her, and the 2 reasons why. First, cash value growth. When you look at the benefits of the cash value, if everything is set up correctly, it is a safe place to put money that's liquid. I can access it like a line of credit. And also, it has some really nice tax benefits. If I do it all right, I can access it tax-free. And then the death benefit, from a legacy standpoint, well, the death benefit is paid income tax-free. On that point, Uncle Bob is a bit older. He's looking at this policy for his 17-year-old niece. Do you think that Jill is the first one to get a life insurance policy in the family? No. Other family members already have life insurance policies. These life insurance policies are trust-owned. They're growing in value, both in cash value and the death benefit value is increasing. Think of it if this happens within your family. There's multiple policies on multiple individuals, all with 7-figure death benefits. Sometimes they're higher than that. And the death benefit is paid income tax-free when each family member dies. What does this result in? A lot of money from a long-term perspective. How about a short-term perspective? Well, I've got that cash value there, which is extremely attractive to a lot of people. So, how does Bob pay for the policy? Because when we have a whole life insurance policy, what can be a turnoff to a lot of people is the idea of paying into it for a long time. And Bob does not want to do that. When Bob had initially emailed us, he said, what I want to do, or what I want to see, is $100,000 total. So in this scenario, Bob wants to bring $100,000 to the table. He said that he wants to split it over 5 years. $100,000 divided by 5 years gives me $20,000 per year. And again, his goals here, maximize the cash value so she can use it, for example, like the business startup we mentioned earlier, and then also have that long-term death benefit that will be paid to the family. Okay, so if this is you, you have this plan laid out, but now you're at the point where you're asking, what should I do? What insurance company should I pick? What product do I pick? Like, what do people actually do to implement this? We're going to go through exactly that. First, I'll let you know what not to do, because this is the most important piece. What I would not do is just buy a life insurance policy that costs me $20,000 per year. And if you were to go to a life insurance company or an agent and said to them, I want to pay $20,000 per year into a whole life insurance policy, the chances are very, very likely that they're going to recommend a basic life insurance policy with a $20,000 premium. They might earn a commission around $20,000 in that case, and you'll have zero in cash value in the first year. So I would not recommend a policy where I take $0 in first year cash value, or I have to wait 10 years or more to get my money back. Here's what I would do. I would put $20K per year into the policy, but I would ask this question specifically. Ask, is the policy set up for maximum cash value? And when your agent answers you, listen to what they say. If you hear something like, as far as I know, yes, or from what I was told, this policy is set up for maximum cash value, or to my understanding, yes, I want a definite yes. This policy is designed for maximum cash value. We can't get it any higher from start to finish. That is what we're looking for, a definite answer. Because where people have buyer's remorse with this entire plan is never the trust or the family office or how the money can be used. No, it's always finding out after they got a policy that they were told it was set up for maximum benefits, both cash value and death benefit long term. They buy it, and then they find out after the fact it wasn't. And it's very difficult to make changes a lot of times after I start a policy. It's difficult to make changes without being penalized or having to pay a fee or transfer it into a new policy. Like, we want to avoid that if possible. So I want to make sure I've got maximum cash value up front, and then I get my money back somewhere between 3 and 6 years. So let's take a look at that. We're going to look at two companies here, Mass Mutual and Guardian, who are two of the 4 major mutual companies. And down here, under what I would do, $20K per year going into a policy. So if we use that number, asking for maximum cash value, it's like, all right, I still don't know what to do. Like, what should I look for here? Here's a tip. First year, if you pay $20,000 in, the cash value should be somewhere between 80 and 90%. So if you take $20,000, what's 80% of that? That'd be $16,000. What's 90% of $20,000? That'd be $18,000. So somewhere in that range with most companies and products tells me that the policy is set up with minimum insurance expenses and maximum cash value. And then also that break-even point between 3 and 6 years. Let's take a look. So what we've got here are two illustrations with Mass Mutual and Guardian. We do have the full illustrations up as well. But for the sake of simplicity, we're just going to walk through these on Excel. So the things we want to look for are what? First year, I pay in $20,000. With Mass Mutual, I've got $16,638. That's between 16 and 18K. I'm above 80%. Perfect. When I look at it with Guardian, same thing here. I'm above 80%. When I look at when I get my money back, this is referred to as our break even with a life insurance policy. It's highlighted here in yellow. So with Mass Mutual, you're between years 4 and 5. Year 5, your total out of pocket is $100,000. You have $102. With Guardian, you are just about there. Year 5, you're at $99,000 and change, whereas year 6, you're at $104. Now, when you look at these two companies, you can't go wrong with either of them. Mass Mutual's product does look a bit stronger long-term, and a big reason why is because we do have a higher dividend rate right now, 6.1%, whereas Guardian's at 5.9%. But what we've seen when we've looked at any of the top 4 companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, when we look at actual policies that have lived the test of time, not illustrations like this, but real policies, we've seen all 4 go back and forth with each other. We've seen stellar results from all of them. That's why I like the top companies, because of that strong proof of performance. But here we see Mass Mutual is a little bit stronger. Where one might refine their decision-making process here is flexibility. So if Uncle Bob says, I've got the $100,000 in my bank, it is purposed for this policy, I'm comfortable writing a check for $20K every year, it's not going to bother me, Mass Mutual works perfectly fine. And you can do the same thing with Guardian. But where Guardian is appealing to a lot of people is the minimum with this policy is a little bit less than $3,600 per year. So call it $300 per month. You could pay just the minimum every year, and then 100% at your discretion, you can add the rest of the money into the policy. It's called how we do that, it's called our PUA rider, paid up additions. I like to call it a cash dump-in. My point is, you don't have to set it up where you're committed or scheduled to pay that $20,000 every year. So if we want some more flexibility, that's where a guardian might be nice. The small nuances about different companies and products is something we spend a decent amount of time on when we're helping someone pick the product that they really feel is going to be best for them, because we don't want the policy to ever feel burdensome or anything like that. So let's look at the long-term strategy with this, and we'll focus on MassMutual here. So she's 17 now. If at age 30, she wants to start that tech business we mentioned earlier, what does she have? $158,000 in change in cash value. Now that could be a little bit higher or a little bit lower based on the dividend rate and if it goes up or down, but over 14 years, it might be somewhere between 150 and 165. It's just me estimating, but I can access it, for example. So I scroll down here. If Jill passes early, let's say at age 60, what's the death benefit? $1.15 million, which is paid to who? Jill's husband at the time? Jill's kids? No. It's paid to the family trust. And that trust specifies how those proceeds should be paid out. Maybe they do go to Jill's family. Maybe they are used to pay off policy loans that are on Jill's immediate family members, like her kids, if they started policies there too. I'm going to see how this strategy is used. So what Jill could do with her policy, the rest of her immediate family members are going to do the same. You'll see a lot of families practice this. They're using the cash value like a line of credit, their own personal line of credit for opportunities. And then the death benefit is really for the legacy piece because it is paid income tax-free. If she passes at 70, death benefits almost 1.65, 80, just about 2.4. If it's age 90, it's at 3.4. And this is going to change drastically over time as the dividend rate and such adjusts. But this just gives you an idea of how these policies are used from a cash value perspective, because again, I can access that cash value whenever I want. That's the appeal for a lot of people. And then the death benefit is really the long-term play when it is all said and done. So I know that was a lot of information. Let's recap. So what's the most important thing with this entire strategy? Is it making sure that the family office and trust is established and all buttoned up? That is very important, but that's typically not where buyer's remorse comes into play, because you can typically make adjustments with that. Where buyer's remorse comes in is always with the actual whole life insurance policy. If it's not set up properly, meaning the cash value is not maximized, that's where people have buyer's remorse. So to recap the overall strategy, number one, Bob gets a life insurance policy for his 17-year-old niece, Jill. Number two, the policy is part of Bob's overall family office, the entire family's family office. It's not just Bob's. Number three, if Jill wants to use her money, who needs to approve it? Dad, Uncle Bob, Liz the tax advisor, and then Stan the business consultant. Number four, the policy is not set up for lifelong payments. Uncle Bob just wanted to bring $100,000 to the table and be done with it. If he wants to add more into the policy that we looked at, he can. That was set up where they can pay into it for longer than just 5 years. And then lastly, point number 5, the policy was set up for maximum cash value. So I do hope that you enjoyed this video. If you'd like to see a video where we talk about how you can choose the right insurance company and really make sure that a policy is set up for maximum cash value, you can check out this video here. Thank you so much for staying with me all the way through. I do appreciate it. And as always, I hope this helps.